Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So we'll dive right in, take a look, and see what's happening in Twitter. If you want to follow me at Finance Square Finance, and if you want to join our community, finding-value.com, I dive deeper into all this stuff, looking for potential investment opportunities and sharing it with the community. I also answer a lot of your guys' questions on the weekends through the question and answer sessions that I do post on the website, even if you can't attend them. So we've got energy headline: drill baby drill is not going to happen, said Shannon Flowers, director of crude and water marketing at Coterra Energy. And we're seeing a lot of things are coming out by Trump that he's going to lower oil prices. And he keeps talking about that. There's two things that he continues to talk about nonstop: lower oil, lower oil, lower oil, and then lower 10-year yield, lower 10-year yield, lower interest rates, lower 10-year yield. He keeps repeating this, almost like he's forcing the market and trying to talk the market down. But the insiders, if you were to ask, if actually some people asked questions during their earnings calls, not this one, but last one. They said, what if Trump was elected and he was going to do drill baby drill? And their answers are, well, we're going to do whatever is economical to do. If companies want to pay us to drill, because it was an energy service company, it was offshore specifically, they're like, we're going to do whatever's economic. It doesn't matter who's in the White House. And that's exactly what the companies are all going to say. Shannon Flowers, director of crude and water marketing at Coterra, is saying drill baby drill is not going to happen. That's the overwhelming answer by insiders of the industry. So a lot of people can say, well, we're going to lower oil prices. That's not a true statement, because all the insiders are saying we're not going to increase production. Chevron's not going to increase production, which is a major shale driller. They said in one of their conference calls, the last one, that they're shifting from basically production flows into cash flows. They're worrying about getting the most amount of money out of those wells, and they're looking at cash flow. So that's kind of the narrative that's going on between the insiders versus Trump and all his tweets. And we'll see a couple of tweets coming up here. CME margin increase. COMEX raises margin rates on gold 8% and silver 6% futures. What does this do? Well, last bull market, when I was experiencing it, when I was a lot younger, very new to investing, what I did see was a whole bunch of margin rate increases. And what it basically does is you can't borrow as much money. It lowers the borrowing amount for gold and silver. So each contract you can't borrow as much. So you can't leverage it up as much. So it slows down the price of gold and silver. They do this as the prices go up to try to control some of the price movements, I think. And we saw a whole bunch of margin increases last bull market, and they were just hitting it real hard. So it's like you're running uphill and you're taking leverage off as these margin increases go up. TTE, which is, I think that's Total, 2025 is looking shaky. The coming 6 months will answer many questions, is their opinion there. I've heard this a lot, even in the conference calls of last year on offshore. Offshore was like, 2025 is looking kind of rough, specifically the first half. And then the later on, it's not too bad. P10, which is another onshore drilling company, they're saying we're going to be sold out in Q2 and Q3, and I think that's from natural gas demand. So there's a lot of natural gas demand now that prices are going up for drilling. Prices are the ultimate deciding factor. Now, is $70 a high price for drilling for oil? No, it's not. Offshore drilling has pulled back. Rig count has declined. Um, $70 oil is like $30 oil back in the day, or maybe even $50 oil a couple of years ago. So $70 oil is not expensive. It is not high enough to incentivize more drilling for oil. Natural gas prices above $4, I think, is an incentive, but definitely not oil around 70. 80 might not even be enough. And we might have to have a sustained price above 80 or 85 or 90 or 100 to really start to get the rig count back up and get drilling back up. So, I'm going to be listening to all these earnings conference calls that are coming out here. I'll probably wait a little bit until there's enough where I can kind of queue them up and just start listening to a whole bunch. I don't like listening to one and then waiting. I kind of like listening to them back to back. So I'll probably listen to that later February or something like that when the majority have increased or have released their earnings and released their earnings conference calls. But 2025 beginning here looks to be the shakiest portion for oil. Seeing loads of bearish dollar charts higher, much higher. So the US dollar is about to implode, and this is a shoulder, head, shoulder, and we're at support where we could potentially break lower. I'm also watching that on the daily technicals here to see if we do get a rollover here. Now, can oil prices go up with this rolling over? It very well could. We could also see gold and silver go up substantially because all of these commodities are priced in dollars. Now, if the dollar starts to go down and other commodity currencies go up against the dollar, so remember this could fall, and this one's the U.S. dollar index, which it's another relative strength indicator. So if this falls, it's falling against other currencies. We could see money flow out of the stock market of dollar denominated assets and go towards emerging markets and other stuff. That's your capital rotation event occurring. Your dollar generally rolls over during those capital rotation events, and we're starting to see gold outperform all those other asset classes. These are all interconnected. Everything in the market is interconnected. So we're kind of at that spot. If I were to compare it back to history, it feels like we're close to 2001, where things are starting to roll over for tech, potentially the S&P 500, and then the dollar rolls over with it. Douglas says how options traders make money. 90% they don't, 10% sell a course on trading options. Trading options is really difficult. Their options are good for like 1% of the time. And that 1% is when you want to put in an option. Now, if you're selling options, that's good. If you're buying options and trying to make money with it, the majority of people don't make money with options. But you can make obscene amounts of money if you use options at the right time. And what is that right time? It's when there's max fear in the market. I will use options at that time whenever that does come, but I'm not going to do it unless the stars align in the system. I do not play options for the most part, and I think that they're incredibly dangerous for people who don't know much about anything. So I think the best thing to do is avoid them for most people. It says you all better wake up. Don't own a house, rent it. Don't own a car, lease it. Don't own a phone, make a payment. Pretty soon you won't own squat. Work the rest of your life, turn around at 60 and wonder why you're still working. Yeah, I agree with that one. I think there are some things that you want to own, like your house. I think it's a good idea. Once you pay off your house, you don't have any more payments. You own the house, and yes, you'll have maintenance. Yes, you'll have property taxes. Yes, you'll have homeowners insurance. I understand all that. But renting, your rent continues to go up. So right now, all of my costs for my house is less than renting. But at least when I'm done paying this thing off, At least I own it, and I won't get kicked out of it. And my expenses per year will drop dramatically. So I mean that's kind of how I am setting up my life. It doesn't mean I'm right. Most of the time, when you run an analysis of rent versus buy, renting generally does really well in the beginning years. So when you compare it, year one, year two, year three, it might be better to rent when you compare those years. But if you do it over a long period of time, a lot of the times it's better to own your house, depending on when you purchase it. If you're purchasing it when it's really expensive, maybe you could even say today is expensive. It might not be as advantageous as buying it when it was really cheap. It really depends on how much money you put down, how long you're going to stay in it. If you're putting no money down and you're basically renting it at that point from the bank, and you're renting it from everyone else, you're kind of in the rented category already. But if you put down a good chunk of a good payment, then it's probably better to own a house than it is to continue to rent, especially if you've got a family and you're renting a larger home. Your rent per month can be pretty large. So I'm in the camp that renting's better if you're going to take a long term approach and kind of grow roots in a certain area. Trump says we will drive the price of oil down. Everything will follow. Um, I don't know how he's going to do that. I'm curious to see how he's going to do that. Right now, we've got low inventory across the board. Low inventory in America, low inventory of strategic petroleum reserves, low inventory in China, low inventory of all these areas. So how is he going to drive the price of oil down? You need more production to drive the price of oil down. And oil is cheap as crap. Oil is cheap and no one wants to drill oil at this price. So I don't know how he's going to do it. I think he's just trying to talk the markets down. More of on the mortgage rate lock in effect. Redfin says 70% of homeowners with mortgages have a rate of at least 6%, the highest share in nearly a decade. But 55.2% are still below 4%, and 21.3% are sub 3%. So 83% of mortgage holders have an interest rate below 6%. I'm at sub 3. I'm not going to do anything with mine. I'm probably never going to sell my house. Um, if I were to move, I would just buy another house and keep this one. My mortgage payment is so small, it just doesn't matter anymore. And that's where I wanted to be. Now, how did I get my mortgage payment so low? Well, you don't have to borrow the entire house. So, take a mortgage that isn't very big, put some money into the house where you've got good equity, and then your mortgage payment is small. My mortgage payment compared to a lot of others that I know that have more recently purchased is about a third to a fourth of what most people pay now. And my mortgage is as big as theirs. So what happened with them? Well, they're going to have to pay a higher interest rate. That's number one. And number two, they didn't put as much money down. So there's other things that they have to pay for, like mortgage insurance and other things. Nat gas capable frac fleets are sold out. That's about 80% of total fleet capacity, says Patterson UTI, which is a drilling company in America. So nat gas capable frac fleets sold out. Every American is owed an enormous tax refund. Prove me wrong. Okay, I can prove you wrong. The majority of Americans do not pay federal income tax. That is over 50%. So I think it's 51% do not pay federal income tax. Of those 50%, some of them get money back, which means the federal income tax, they are getting more money back when they do taxes than what they pay in on some of those people. So every American is not owed an enormous tax refund. Those that pay taxes would be maybe qualify for a refund. But people who don't pay in, they should not get money back, period. In fact, I think everyone should be paying some sort of tax. That I think would align everyone better in this world on how they vote. Because if you're not paying any taxes, you have zero stake in society. So you got to be able to pay some tax and be like, you know what? I don't like paying tax. So everyone is in the same camp, at least, contributing to this beast of I don't know what. Buy right, sit tight, says Rick Rule, and I agree. So this is Peter Lynch, one of the greatest growth investors of all time, once said, if you're in the right stock, it's better to hold on for the long term. He used these metrics to select stocks: PE less than 20, forward PE less than 15, earnings per share growth greater than 15%, profit margin greater than 15, return on invested capital greater than 15, and debt divided by free cash flow less than 5. That's kind of the one, if small debt. The one that basically paces you is your return on invested capital. So if you can dump money back into the business and it grows at 15, 20, 30, 40%, that's your return over the long term, basically. All your other returns is, if you're above 15 and your return on capital is 15, you're basically sucking up your price to earnings ratio. It's going up. You can buy something that's really cheap, like an oil stock. Their PE ratio might be completely jacked at bottoms because they're not making a lot of earnings. And then if the commodity price goes above their break even, their return on invested capital could go ridiculously high. It could be 80%, 90%, 100%, depending on how fast and how high the commodity price goes. Their profit margins can grow rapidly. That is why I like the commodity companies, because they can have many, many decades of returns in very short periods of time based off of the commodity price. And the commodity price determines all of these metrics, if you wanted to know. Garrett Goggin says QE5 yield curve control is coming. Perpetual money printing. The Cent's focus on bringing down borrowing costs is 10-year Treasury yields rather than the Federal Reserve's benchmark short-term interest rate. You know who I think is going to benefit from this the most? Home builders. We have low inventory of existing homes. If they bring down the 10-year yield, which is basically bringing down the mortgage rate, they're going to send home builders higher if they're successful at doing this. So far, gold and silver will go up too. They love money printing and lower interest rates. So far, the second biggest withdrawal season in the last 9 years, this is nat gas. These are withdrawal seasons, 16, 17, and we're way down there with the second largest withdrawal during the season. Trump wants OPEC to pump more oil to lower prices, but the cartel isn't budging. With Saudi Arabia focused on Vision 2030 and OPEC prioritizing market control over politics, Trump's request is likely his first major reality check. I know Trump's been saying we're going to lower oil prices. I don't know how he's going to do it. I really don't. I think it's all bark and no bite. OPEC is not falling for it. I think Trump wants lower oil prices so he can fill up the strategic petroleum reserve. That's my guess. And he's trying to get everyone to pump more, but I don't think they're going to do it at these prices. Saudi Aramco boosts oil prices to Asia by most since 2020. So prices to Asia rise by the most since August of 2022. Gains follow surge in Mideast crude prices, improved margins. So Trump wants lower oil prices and OPEC sitting here raising them. I love it. The rarest and most valuable thing on this planet is a clear mind, says Nassim. Here's the Crude Chronicles. This is ConocoPhillips. These are always some of my favorite charts to build to understand how a company came into being. You often have to know its history. So this is the history: Arco, Alaska Production, Phillips Petroleum, Continental Oil, DuPont years. This is Gen Am Oil. Now, here's one thing that I look at. When you look at ConocoPhillips and you look at all this, it basically peaked in 1970, and it really hasn't increased production materially over 1970. So the big growth phase, it started in 1922 Marland Oil, Independent Oil and Gas. And it grew all the way to about 1970. That was the peak of conventional oil. That peak came down and it's declining. All of this new stuff over here, my guess, is mainly shale oil and shale natural gas production. So what's happened is they hit peak oil in 1970. It's geology constrained. And no matter what technology they throw at this, they haven't been able to increase production materially for this company. And they've been doing buyouts of other companies. They've been producing from other areas. I don't think they're going to be able to produce more oil. I think this is going to roll over eventually. And there is ConocoPhillips reconstructed oil and gas production by geography. So they've gone up, but they've had to go outside of the United States. So this is Libya and other stuff. And then this will be the ultimate peak in 2006. 2006, so if we look at US, the ultimate peak in US was 1970. In the world, it was right around 2006, 2007 era. So that's kind of conventional. And then oil sands and shale oil and all that stuff came on after that. But this is the peak of ConocoPhillips 2006, and it's been heading lower. And I have a feeling that this is going to be, yeah, here's your lower 48, the peak in 1970. You can see it peaked, came down, and then shale is the more recent upsurge there. So this is going to be rough. It's going to be rough for some of these big companies. I think they're going to struggle to hold production flat of their companies. EV math, save $5,000 on gas, but lose $25,000 in depreciation, and they are the smart ones. I don't know if that's true or not. I know EVs do have a lot of depreciation. I don't know how much they cost. Um, I I just don't like buying new cars in general. I buy the cars after they've depreciated a whole bunch. There are cars out there that I think are pretty cool that you can get pretty cheap. And if it sucks down some gas, I don't drive that much, so I don't really care. EV, I don't drive that much, so it really doesn't impact me. If I were to do something with an electric vehicle, it wouldn't be a car. It would be like a little scooter. That's what I would do, and then I would have gas cars. Is probably what I would how I would set it up. Eric Nuttall says Canadians have finally woken up to the strategic necessity of building more oil pipelines that will reduce our customer concentration risk, narrow our price discount, and unleash our full resource potential to the benefit of all Canadians. And I hope they do that. I'm invested in Canada, in Canadian oil. I'm pro Canada. I'm pro America. I'm pro all this stuff. But I do think what Trump did was not that great against Canada. Maybe there's other ulterior motives that I don't know. Very well could be. But this will benefit the price of oil in Canada if they build more pipelines out to the seas. And this is something that Trump, I think, has started. He's going to Canada is going to create. They're going to be a stronger Canada if they do this and more robust. And Trump's going to be the one to blame for that. U.S. housing foreclosures by quarter. Look at this. Oh yeah, we have a huge surge going on. On a percentage term right here, this is probably a big percentage gain from like basically zero to here to here. These are big percentage gains. But overall, this is really low compared to where we were back in '04. Or '04 was huge compared to where we are today. The big crisis obviously came later. And then this, we had to work through all this, which took a couple of years to work through all that inventory. Gold front runs liquidity by 12 to 18 months. You've been warned. And we've seen gold rapidly going up. I think the liquidity is coming behind it. It started going up in October of 2022. So add 12 months, that puts us into 2023. No, wait. Was it 2022? Yeah, it bottomed in 2022. So add 12 to 18 months, and gold's been going pretty vertical here recently. So maybe liquidity's coming in, and maybe we can see that in oil prices eventually when we start going back up. And then when oil started going back up, gold kind of went into a big consolidation sideways. But gold goes up with liquidity. As gold miners start to move, it's important to put into perspective where we are in terms of valuations relative to history. Based on price to net asset value metrics, these companies are currently at their most undervalued levels in 4 decades. Let the bull market begin. And this is gold equities have rarely been this cheap since the past 40 years. You can see a downtrend line going here too. We haven't broken the big downtrend line, but we will at some point. And it's going to be a fun run to get back up around 2. Coming from these levels with a very large increase in gold prices, I think. So, yeah, it'll be good. Mr. Besant gets it. The credit market leads the Fed, and Besant says he and Trump want lower 10-year rates, not Fed cuts. They want lower 10-year rates. Thank you, Dr. Alal. So this is China oil inventories in million barrels. Look how low it is. That's also at 5-year lows for this time of year. So we're low on inventory across the board here. China, United States, Strategic Petroleum Reserve, all over. It's all low, 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 low. Hedgehog Trader says copper versus NVIDIA weekly, epic battle playing out, hard assets versus tech juggernaut. It looks like a falling wedge ready to break to the upside, where copper could outperform NVIDIA, and that could be your capital rotation event type deal. Looks good for momentum and relative strength indicator and stuff. Why is the 10-year bond yield in free fall? Bad job? No, they're just buying it, guys. They're in there doing QE already. And this was one from yesterday. So we're going to end it there. Give me a thumb up for the content, guys. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. This is Finding Value.